Interest rates have risen and the real estate market is starting to feel the pressure. But smart investors know how to turn challenges into opportunities. Today, let's take a look at how the market responded to the mid-2000 rate increase and how savvy investors can still make smart decisions. Now, before we get started, don't forget to like and subscribe to my channel for more information on how to be successful in real estate. It's important to analyze and look at past data and past market cycles so we can make an informed decision when investing in real estate. I like to call this R&D. Now, I'm not talking about research and development. I'm talking about rip off and duplicate. That's right. There's no point on reinventing the wheel when it comes to investing in real estate. We can very easily look at previous market trends and make the best decision moving forward. This isn't the first time we've seen interest rates rise, and we've seen an up and a down in the economy. Back in the 80s, interest rates rose to astronomical numbers, and even sooner in the mid-2000s, we had interest rates go up. Let's take a deeper dive into the mid-2000 rate increase and what we saw then to help make an informed decision and a good strategy for investing in real estate. In the early 2000s, Canada's economy was recovering from a downturn. Bank of Canada started to lower rates slowly to try and stimulate growth, and we saw a low of 2.25% in about 2004. Then, of course, we started to see inflation, much similar to what we're dealing with right now. By mid-2006, the overnight rate had increased to 4.25%. Now, of course, with this increase of interest rates, we started to see a little bit of a slowdown in appreciation. In some of the larger cities, we even saw a little bit of a correction, such as Toronto and Vancouver. So now, with appreciation slowing, what do people start looking for? They start looking for cash flowing properties. If you can't buy a property and it's going to appreciate in value substantially in a short period of time, we need to start looking for cash flowing properties that are going to pay dividends monthly over a long period until we start to see some more economic growth and we start to see that appreciation happen again. Investors who bought properties in 2006 and 2007 saw some real appreciation in about 2010, 2011. Another thing to consider is diversifying your portfolio. When high hit areas like Toronto, Vancouver, the larger cities are getting impacted, it's sometimes a good idea to start branching out and looking at the smaller towns that don't see the rise and the fall like some of the larger cities would feel, with a more stable price dynamic and rental demand. So similar to the mid-2000s, the situation we're in now, we're starting to see interest rates, they went up and now they're coming down a little bit, which has had a cooling effect on the market. We're also seeing an increase in inventory, meaning there's a lot more properties for sale on the market. So just like the mid-2000s, if you're investing in real estate, you need to think of it as a long-term steady growth plan, not a get-rich-quick scheme that's going to happen over the course of a year. Of course, with raised interest rates, there's also the consideration that, well, as affordability gets harder for people with variable rate mortgages, they're going to be looking to exit the market, and there might be some opportunities for properties at a discount. These are the type of properties that you could buy, hold on to, improve, and then sell down the road in the future long-term once it appreciates. Now, I know it's nerve-wracking to think, well, it's just not a good time to buy. I shouldn't get into the market. I'm going to wait till it hits the bottom. Well, they're already lowering interest rates. We're already seeing that from the Bank of Canada. They've curbed inflation. And if history tells us anything, I wouldn't be waiting. I would be looking right now and strategizing, because the smart investors are going to be poised and ready to take action when the right property comes up for the right price. I went into ChatGPT and I entered all the info in that I got from the real estate board about the Canadian market. And I asked ChatGPT to build me a graph from 1986 to the current market. What I have here is in blue unit sales, in orange active listings, and in green average price. So we go to 1986. The average price is starting to increase. And if we go here to the mortgage rate, prior to 1986, that the rates went way up. The blue is the benchmark Bank of Canada rate, and the orange is the prime rate. Prior to 1986, interest rates were high. Active listings started to increase quite a bit. As we start to get into 1986 and past, we see the interest rates start to come down. And as we get into 1986, the average price starts to increase. The Bank of Canada raises rates going into probably about 1990. It goes up to a crazy high up here. As it goes on, all of a sudden, we hit that same little block right here in the average price and things start to come down. Unit sales start to decrease and active listings start to go up. Fast forward, we'll go to, I'm gonna say leading up to kind of 1990. All of a sudden we see the rate start going way down here And what do we start seeing? We see unit sales increase, average price start to increase. And then active listings starts to go back up when we look over here that the interest rate starts to spike up again. Now when we go to 1995, you'll see the interest rates right in 1995 peak out right here. And if we go right here, we'll see that there's that little dip. Now that was the interest rate going up, which in turn affected the average price of a home. So the average price of a home started to correct a little bit and come down. And then when the interest rates are up at an all-time high, again, unit sales decrease, our active listings increased here in 1995. After 95, they start to lower the rates again. And what happens? Our active listings start to go down, our average price starts to go up, and our unit sales go way up and spike. We'll fast forward to the 2003, 2008 kind of deal here. So we go over here, we see the price is steadily going up because interest rates have kind of leveled. And then all of a sudden, right in that same kind of time frame, average price starts to come down. Unit sales take a huge dive and come down. Active listings spike up. As the interest rate starts to go up, unit sales starts to decrease slightly or slow down at least on its curve. And then we see active listings go up. But then, of course, on the turn, once interest rates start to come back down, really quickly we start to see the average price go up and we start to see active sales increase as well. If we fast forward to today's market, what we have is unit sales has come way down, average price has started to come down a little bit as well, and active listings is increasing. The Bank of Canada has already signaled that they're starting to reduce rates. So we know what's going to happen. As soon as the rates start to come down, we're going to start to see active sales increase and in turn, active price come up. Now I get a lot of people that say, I don't want to buy a house because the interest rates are too high. But let me ask you, would you rather buy a house at a lower price or at a discount at a slightly higher interest rate that you can turn around and remortgage for the next year when the rate goes down? Or would you rather buy a house at a lower interest rate and a way higher overinflated price? I hope your answer was you would rather buy a cheaper house at a little bit of a higher interest rate. Now, of course, I don't have a crystal ball. The interest rates could go back up a little bit and change things. But like I said, if you're always investing in real estate from a long-term perspective, if you look at that green line on the graph, it just steadily keeps going up, has little minor corrections, and then continuously goes up. So you really can't go wrong investing in real estate. Thanks for checking out my video. Don't forget to like and subscribe, and check out this other video about how to find cash flowing properties, including 3 places in Canada you might want to consider investing.